Hello, everyone, and welcome to our financial webcast presented by Legend Financial Advisors, entitled Last Chance to Reduce 2022 Income Taxes. My name is Dan, the moderator for the webcast. Today's webcast presenter is Jim Holtzman, CFP, CEO, President, and Wealth Advisor with Legend Financial Advisors. Please hold as I turn it over to Jim.
Okay, thank you everybody for joining us today. I anticipate this will probably go, at least my presentation part will be about 50 minutes, maybe a little bit more than that. Got a number of slides that I'm going to share with everybody. I will try not to go too fast, but I want to make sure that I cover the topics so that everybody can get a feel for opportunities for this year. Not all of these topics will apply for everybody, but I'm hoping there's at least a few things everybody can take away from this. So the first slide that I put in is just simply how do you calculate taxable income? Because oftentimes I will hear just in terms of determining the tax rate you're in, that oftentimes it'll be based upon your gross income. And that's not the case. And depending on your situation, the difference between gross income and taxable income can be really quite different. So what I put up here was the starting point of your gross income. Then you subtract away any what are called above adjusted gross income deductions, and these would show up on basically before you calculate your AGI. And there's only a few of these, but whenever they do apply, oftentimes they can be pretty large. Then from there, you want to subtract the greater of your itemized deductions or your standard deduction. Now, a couple of years ago, they took away a number of itemized deductions, kind of made it more difficult to itemize. So I think we see now a majority of taxpayers are actually using the standard deduction. But you get to subtract the greater of the two away, again, from your gross income. And now we're at least a few years away from this. Personal exemptions went away back in 2019. So really at this point, you have your taxable income. So it's your gross income minus these various deductions, the greater of your standard or itemized deduction, and that's how you get to your taxable income. Then from there, you apply the tax rate schedule. So this one is for single filers. So in these two columns, I have this year, the tax rate and the taxable income. And then I do have last year's in here just as a point of reference. So the way you want to read this is if your taxable income is between $0 and $10,275, your tax rate is 10%. Then as you move on to the next rate, it starts at about $10,276 and goes up to $41,775, and that's taxed at 12%. I'm not going to read every one of these rows. I just want to give everybody a feel for how to read through this. One other point that's important to understand is that when you're in the 12% tax bracket, it's not that all of your taxable income is taxed at 12. It's only going to be the portion that's in this range. So you still will have 10% tax rate applying to the first $10,275 of income. And then from there, you're really just rolling through the different tax rates. We have 22, 24, 32, 35, and then 37. Now, the 37% tax rate applies for taxable income more than almost $540,000. So it's really quite a large number in that case. You can also note that the tax rates did not change since 2021. However, the range of taxable income does change. It gets inflated every year. So you can see in 2021, 10% tax rate was $0 to $9,950, and again for 2022, it was $0 up, and then now it's up to $10,275. Same looking type of a chart, except it takes care of those that are married filing jointly. You read it exactly the same way. What you will maybe note is that the taxable income ranges are basically double what they were for single filers. So for the first, the 10% bracket, it's $0 to $20,550. And then really from there, you're reading this exactly the same as the single filer status. Trusts and estates, this is a different type of situation because you reach the top bracket really quickly as far as taxable income goes. So we have 2022, 2021, and the taxable income range. So you can see for the 10% bracket that covers from $0 to $2,750, and you will also note there's only 4 tax rates. And the biggest thing that jumps out is when you hit the 37% tax rate, that only applies for $13,450 and more or greater. So you reach that top bracket really quickly. So if you have a situation where you're dealing with a trust or maybe working through an estate, the income tax planning can be very important applying to that. So as we head in towards the end of the year, there are opportunities to mitigate or maybe eliminate underpayment penalties. So what happens for federal and for state purposes as well, you have to pay in so much tax during the year to avoid an underpayment penalty. And basically that's an interest rate charge. So with interest rates going up this year, the interest rate the IRS uses to calculate the underpayment penalty is going to go up as well. I don't have that current number, but even before this year, I believe it was somewhere around 4%. So I'm sure it's gone up this year, and this becomes a much more meaningful situation. So there's two ways to avoid it, or two tests that you need to follow. So you can pay the lesser of 90% of your current year taxes, or you can pay 100% of last year's tax, meaning 2021, or 110% of last year's tax if your prior year AGI, which is adjusted gross income, is greater than $150,000. So the way to simplify the explanation of this is that it's the lesser of these two. And if you have a situation where your taxes have jumped up a lot this year, your taxable income really has jumped, then targeting the prior year can make a lot of sense because it's a fixed number. You know the tax number from last year, and then you're just applying which of these two applies to your situation. So as long as you pay that amount on a quarterly basis to reach, say, 100% of your last year tax number, you're in good shape. Even if you owed $100,000 in April of 2023, as long as you have met either one of these two, then you will not owe an underpayment penalty. Now, on the other side of it, if you have a situation where your taxable income, let's say, has gone down a lot this year or has increased a lot this year. So in that case, actually I got a flip-flop. Let's say you have a situation where your taxes are going to be much higher this year, then you will want to, I think I still got a flip-flop. If you want, what you want to do is, in this case, let me simplify with an example. Let's say you have your tax bill is going to be $10,000. And 90% of that will be $9,000. And last year's situation was such that the tax bill was much higher. So paying the lesser of 90% of the current year tax is going to be a better way to go in that case, because you don't want to pay in 100% of your prior year tax if this year's tax number is going to be so much lower. The only problem or issue you need to think about with paying 90% of the current year tax is that the number is going to fluctuate throughout the year, because you just don't know where your final tax number is going to end up. One other thing you can do, so this is where you determine if you want to make estimated payments. The other situation is that if you have the ability to use federal tax withholding between now and the end of the year, you can increase that as a way to also avoid the underpayment penalty. And in that case, the withholding will be applied throughout the year, whereas an estimated payment applies on basically the date the IRS receives your money. So there is some planning you can do here. And now that we actually have money market rates that are much higher than they were a year ago, if you owe a lot of money in April of next year, well, you might want to try your best to keep the money in your hands now, because you can actually earn some interest, as opposed to the last 14 years where you pretty much were really earning nothing on your money or on your cash. So for state estimated payments, if you're in a state that has an income tax to begin with, then you don't want to forget about this as well. Most states will have the rules set up that you pay the lesser of 100% of your prior year tax or 90% of the current year tax. So I don't think there's any states that have an income tax that run the rule differently, but you'd want to check in case that applies to your situation. Now we're going to talk about portfolio income and the impact on your taxes. So the first thing is that, and we're doing this a lot for our clients right now, is we're recognizing capital losses where possible for our clients. You'll hear the term tax loss harvesting used. And the way that works is that if you have capital gains, let's just say in the current year that you've incurred, then you can sell investments that have a taxable loss, and you can use that to fully offset the capital gains. Then, if you have more capital losses than capital gains, you're allowed to take $3,000 of that, and you get to apply it against ordinary income, say your wages or dividends, for example. And then if there's anything left over from there, you get to carry that number forward into 2023. So if you had, let's say, $10,000 of capital gains and you had, let's say, $20,000 of capital losses, you could fully offset the $10,000. You would take $3,000 and apply that to other income, and you're left with $7,000 of capital losses that you can carry over into a future year. Now, this only applies for taxable accounts. You can't do this in a retirement account because the earnings that you accrue in a retirement account are tax deferred. One thing you have to be careful of is that with what are called the wash sale rules. So the IRS says if you're going to sell an investment and recognize a loss, we don't want you to just do that and then buy that investment back the next day. They want you to take some, I guess as they call it, economic risk. So you have to wait a period where you cannot buy that investment, that specific investment back within 30 days. There are some ways you can get around this. And you can replace that investment with, say, another security that's in the same industry. Maybe it's the technology industry, for example. Or if it's a stock, maybe it's in technology. Maybe you buy a mutual fund or an ETF that's in the technology area. In that case, that sale of that stock that has a loss, you'll be allowed to write that off. Now, if you do have a situation where you sell the stock, you have a loss, and then you buy it back, just say the next day, all that happens is you're basically your loss is disallowed, and it's like you never sold it in the first place from that standpoint. So this has been a strategy we put in place for our clients this year. In the beginning of the year, before the market started to fall apart, basically, we were able to take some gains off the table for our clients from earnings that had accrued over the last 5, 7, even 8 years. And in that case, we went into this year after the first couple of months with some pretty large capital gains. Now we're on the other end of the spectrum where we're looking through our client accounts, each one of our client accounts, to see if there's any capital losses that we can take to at least help mitigate the capital gains taxes that will be coming. And then what we've been able to do as well is that at least in one case, we sold an investment and we replaced it with a security that was sort of in the same industry. That way for our clients, we were able to keep the exposure to the markets that we felt was appropriate. And that's worked out really well. As this investment that we replaced it with has done extremely well. So as opposed to just selling, putting the money in cash and waiting for that 30-day period to expire, we didn't have to worry about that. And we were able to give our clients participation in this recent rally that has occurred. So if you're going through tax planning, you want to make sure that you look at your prior year tax return, because if you had that capital loss carryover I mentioned before, then it's easy to forget about that. So take a look at your last year return, see if you have a loss carryover, because that amount would apply for this year and can help reduce your capital gains. Now, as far as recognizing capital gains go, the way this will work is that it's broken down into two periods. You have short-term capital gains, which are for a holding period of 1 year or less. In that situation, the tax rate is going to be your ordinary tax bracket. So if you have a long-term capital gains, which is a holding period of longer than 1 year, if you are in the 10 and 12% bracket, you actually have 0% capital gains tax to pay. If you're in the 22 through 35% bracket, you have long-term capital gains rate of 15%. And if you're in the very top bracket, your long-term capital gains rate goes up to 20%. So there's a lot of tax planning that can be involved here. Let's say that you're retired, you don't have a lot of portfolio income in taxable accounts, and maybe you are in the 10 or 12% bracket. Well, you want to be sensitive to understanding that you might have 0% long-term capital gains rate, and maybe you can sell down stock, for example, that has really run up in price that you've been holding off selling because of concerns about the taxes. So you got to do some planning in here. We run projections for our clients to navigate through that situation, but it's an interesting opportunity that does apply. The other part for what they call the qualified long-term capital gains rates is that it applies for dividends as well. So in this case, if you have a dividend that is qualified, long-term capital gains rates will apply to it. And if it is non-qualified, then your ordinary tax rates apply. So what is a qualified dividend? Typically, it's going to be a dividend that comes from a U.S.-based company, whether it's from a stock or maybe from a mutual fund that is U.S.-based. Non-qualified, it's going to be from a real estate investment trust or REITs, maybe a bond fund that is paying out uh, ordinary dividends or non-qualified dividends that'll be taxed at ordinary tax rates because it's coming from a bond. So those are a couple of ways to differentiate between the two. Now, year-end capital gain distribution. So again, this all applies for taxable accounts. And what happens is typically as you get towards year-end, it especially applies for mutual funds. They're required to pay out their dividends or capital gains that they've incurred within the fund on an annual basis. So what will happen is that usually in November, December, the funds will pay out a distribution if they have capital gains to apply. And if you're making some portfolio adjustments, you don't want to buy into the fund before it pays the distribution. And this year has been kind of an interesting example because if you buy into a fund and let's say they had capital gains from selling investments because of the downturn this year, they had a lot of built-in gains. So you could buy into a fund that pays out a capital gain distribution, and let's say the market goes into maybe a downturn for the rest of the year, and then you bought into an investment that falls in price, but then you're still stuck with a capital gains bill from earlier, or maybe the gains that were incurred over the last couple of years. Exchange traded funds, they can still pay distributions, but one of the benefits of an ETF is that they're pretty tax efficient, but don't assume that they can't pay out a capital gain distribution. So it's just another form of due diligence we have to perform for our clients when we're buying or rebalancing at the end of the year. I'm not going to spend too much time on this slide. It's a little bit deep, but it is important to know as ETFs become more popular, the taxation is a little bit different. So if you buy, and maybe go into the third example, if you bought an ETF that has exposure to gold, the actual gold bullion, or maybe silver is another area, those ETFs have to be structured as a trust. And what that means for the bottom line for you is that any long-term capital gains rates have a separate tax rate of 28%, not the 20% or 15% I showed you in the prior slide. These are treated a little bit differently. If you've been using ETFs that invest in foreign currencies, they will pay basically ordinary income. And then if you have an ETF that is structured as a limited partnership, what will happen is that you're going to get a K1, which is a different tax document than, say, a 1099. That'll report your income, gains, dividends, whatever the case might be. And that's going to be a separate document. It adds a layer of complexity to your taxes. And when we can, if we run into these situations, we will try to put these type of ETFs maybe in a retirement account. So that way the effect probably won't have any type of an effect as far as getting your tax return completed. Just some things to think about as you're maybe using some investment ideas or making some investment decisions, understanding the tax impact that'll come later on whenever it's time to file the tax return. Cost basis reporting, it's interesting. This is basically a decade old now, but I still put it on this presentation because of the fact it still shows up. And what this means is that your brokerage firm, say, just say it's TD Ameritrade, your custodians required now to report cost basis, where before they were not required. Some did, some didn't, but now they're required to. So it runs into a situation where let's say you had a stock that you've owned for, let's just say 30 years. The brokerage firms are now required to report the cost basis for stocks that are bought on or after January 1 of 2011. Well, if you've owned the stock for just say 30 years, you might have a situation on your statement where there's no cost basis because they don't know it. So when you sell that investment and you get your 1099 at the end of the year, they're using the data that they have. So if it's something that's been 30 years old and they have nothing for the cost basis, it's going to show up as a big zero on your 1099. And if you don't catch that and make the adjustment and find out what that cost basis was, you could end up really paying a lot of capital gains taxes. So it still comes up. We still see this issue coming up on client statements. Mutual funds, same thing applied. That happened basically in 2012 and going forward. And for options and fixed income or bonds, that applies from January 1, 2013. Now, a worthless investment is an investment, let's just say it's a company that's gone bankrupt, it doesn't trade anymore. You are able to treat it as sold on the last day of the year. So as long as there's basically no market available for that particular security. So if you have anything like this, you're looking at maybe taking some capital gains off the table. If you have a worthless investment, this could help offset that capital gain. Now we're going to talk about itemized deductions, and I'm not going to spend too much time on it because there's so few that itemize anymore. It's about 7% of taxpayers at the last time I had seen it, whereas before they made the changes to the law, it was about 30% were itemizing. So that shows you how much less these issues will apply, but we'll still cover it. So you have the standard deduction. So this will be a flat dollar amount that applies based on your filing status, which I have all of them listed here. And you can see I have 2022, I did keep 2021, and I'll just give an example of one of these. If you're married filing joint, the IRS gives you a $25,900 deduction. So if your itemized deductions add up to be more than this, then you can itemize. But as I'll go through these next few slides, you'll see it doesn't apply as much. And just so everybody knows too, we are making these slides available for everybody, and we'll also send out a replay of the webcast, as I realize there's a lot of numbers and detailed information here. There's also what's called an additional standard deduction. So just sticking with somebody that's married, if you're older than age 65 or if you're blind, you get an additional standard deduction, and that's $1,300 for this year. It does change for somebody that is single. Mortgage interest, so they made some changes to this back in 2017. You're able to write off the interest expense for the first $750,000 of debt. And then if you had a mortgage at that time, a balance up to $1 million, that mortgage interest is fine. You can still write that off as those rules were grandfathered in. And this applies for up to 2 homes. Home equity interest, they kind of tightened this up a few years ago as well. You can still use a home equity loan or home equity line of credit to buy a car. Interest rates are usually going to be better than getting an automobile loan. However, in that example, the interest expense will no longer be deductible. The only part of a home equity loan or line of credit where the interest expense is deductible is when you're using it to acquire or basically improve your home, maybe putting a roof on the house. So in that case, the interest expense can be deductible, but for a car or anything basically not tied to the house, you can't write off the interest expense. Charitable contributions, some slight tweaks have occurred over the last few years, but basically to a public charity, if you cut a check or give cash, you can deduct up to 100% of that up to your adjusted gross income. So there used to be some limitations, more limitations for cash donations. So it's a little more easier to write these off. There is actually what's called a charitable contribution carry forward, kind of in the same vein as a capital loss carry forward. So if you run into a situation where you can't write off your deductions, then you can carry those forward. But it doesn't apply whenever your standard deduction is more than all of your itemized deductions. And then I always get this question at the end of the year. If you have a charitable contribution you're making, let's say you mail a check, as long as you do it on the end of the year, the last day of the year, or before, you can write it off for 2022. And any credit card charge, as long as you make it before the end of the year, can also count as a deduction. What I'll call the new charitable deduction, this is not a very large deduction, and it started back in 2020, is you can write off for married filing joint $600, or if you're single, $300. You can write that off on your tax return, or what we call that above the line deduction I'd mentioned at the beginning of the presentation. And that's where you have some deductions that you can write off before your adjusted gross income is calculated. And the benefit of this is that there's no kind of hurdles you have to jump through to write it off. It's a straight write-off. It's very limited in terms of what they allow you to do. But if you're not itemizing, then you have another option, at least for some portion of your charitable contributions. And if you do use this, you can't itemize your deductions. So you just have to look at what's most beneficial to you. Donor advised funds, these might become more popular with the fact there's so many limitations on writing off itemized deductions. So this is a fund that you set up, and you can gift, say, a security into the fund. And if you, let's say you have a stock that's had a big capital gain over the years, and you don't want to incur the tax bill, but you do have charitable intentions that you want to take care of, and now you're in a situation where you don't itemize anymore. So you can set up a donor advised fund, gift that stock or whatever part of that stock you want into the donor advised fund, and then the donor advised fund can sell the stock, no capital gains tax, and then from there you can distribute that cash out to the charitable contributions you normally would make. So it's a pretty tax efficient way to do things. If you want to get really creative, you could maybe do 5 years worth of your charitable contributions, whatever that dollar amount is. Let's say that's $40,000. You do $8,000 a year, and you put the $40,000 of securities into the donor advised fund, and then you sell it off. You make your distributions over that 5-year period. Well, in the year you make the gift, that $40,000 can count towards your charitable contributions, and that could be a way where you get to itemize in that particular year. You won't probably itemize every year, but it's a way to at least take advantage and have maybe 1 year out of every 4 or every 5 where you can actually itemize your deduction. Now, when you put the fund or the stock into the donor advised fund, you're not required to sell it. You can because it's an incentive because you're not going to incur the capital gains tax, but you could also leave that stock or mutual fund ETF in there, and you can leave it alone, let it grow, or you could sell it and maybe invest in other investments, and then all of that appreciation will escape income taxes. So it's a pretty cool method, and for a number of reasons, it allows you to get a stock or a fund that you have a big built-in gain and move it out of your tax situation. Medical expenses, they're still tough. You have to exceed 7.5% of your adjusted gross income before you can write that off. And that's a pretty big number in a lot of cases. Miscellaneous itemized deductions, they just don't apply anymore. So it used to be things like tax prep fees, investment-related expenses, things like that. That is completely gone. And I think the way the tax law is written right now, that this will get revisited probably in the next couple of years, as there was an expiration date on this. State and local income taxes and real estate taxes. So the way this was tightened up is that there's a $10,000 cap now for your state income tax, local income tax, real estate tax, if you have a personal property tax. So when you add all of these areas up, a lot of times, especially in a high real estate tax state or a high income tax state, that amount will easily exceed $10,000. And whereas before you could add all of these up and write them off, now there's the $10,000 cap. So you can kind of see a theme as I go through these. There's a lot of limitations for your itemized deductions, and that's why just not as many taxpayers itemize. There is still a sales tax deduction, and the way that works is you can claim the sales tax. It's the greater of your sales tax or your state and local income tax. And so if you have a couple of big purchases, a couple of cars, maybe your sales tax is really high in that year, you could use that. There's a table that the IRS provides that kind of gives everybody a flat sales tax number depending on your situation. But oftentimes, because of all these limitations, it just doesn't even matter. But it's good to know behind the scenes this area applies, but then this falls under that $10,000 cap. So just really a big struggle to get any of these tax benefits that used to be available. We'll talk a little bit about credits now. So a credit is a dollar amount that reduces your taxes dollar for dollar. So they're really beneficial when they apply. The first one we'll cover is what's called a child tax credit. And so there's some changes in this over the last few years, and this year, meaning 2022, it's kind of gone back to some of the old rules. And for the child tax credit, it applies for children aged 6 to 17 and runs at a $3,000 rate. There is a phase out for this. And when I talk about phase outs, which you hear that term throughout the rest of the projection, what that means is that as your income gets to be what the IRS says is too high, then you either lose some of the credit or the benefit, whatever we're talking about, or at least a portion of that. So you can see, without getting into the nuances of the calculation, if you are at 400,000 of AGI, or what's called modified AGI, for a married filing joint, situation, then you're going to start losing some of the benefits of this. And then it's $200,000 for any other taxpayer, say if you're filing single. The child and dependent care credit. So this is a credit you can take if, let's say, you're using some kind of say it's daycare, say if it's something like that that allows you as a parent to be able to work. So there's a credit available. Of course, there's limitations for that. And the way it works is that there is an $8,000 cap on expenses for one child, and there's a $16,000 cap if you have two or more children. It applies for a dependent that is under the age of 13. And again, the whole point of this is to allow parents to work. That's why they have this credit available. And what comes down to is that it's 35% to 50% of the expenses, whatever that might be. That's how you end up calculating that. And of course, you have the AGI limitations that will apply as well. So just, again, some of these things, if you're not familiar with them, you're not going to grasp it all in this webcast, but to know these opportunities are available is really the main takeaway from this. Now, these are becoming more popular with electric vehicles. There is an electric vehicle automobile credit. And so right now that ranges from $2,500 to $7,500. The Energy Department has a website where they list the vehicles that apply for this, and we have that listed right here. And the amount of the credit depends on the size of the vehicle, the battery capacity. So it gets a little bit into the weeds when you figure out how much will apply. But the website is very helpful to find out if your car applies in the first place. And oftentimes when you go to the dealership, it'll say that it applies for this particular credit. So a big one now is going to be healthcare expenses. So this chart is very confusing, but it's very important. This has to deal with Medicare Part B and Medicare Part D, which is for prescription drugs. So what happens here is that if your income is too high, then you will pay a surcharge on your Medicare B and Medicare D premium. The technical name for this is called income related adjustment amounts. You will hear it called IRMA more frequently because of just how long this name is. And I'll try to make this as simple as I can. You have different income levels. MAGI, again, is modified adjusted gross income, which for most people, it's going to be your adjusted gross income. We have different filing status as single, joint. We'll just focus on these two. And I'll go through one row, maybe two rows, so you can have an understanding of this. So as we work our way to the first row, let's say we're focusing on single. If your modified AGI is $91,000 or less, you don't have any problem. You're not going to pay a surcharge on your premiums. So as we kind of jump over to this column, this is for Medicare Part B. So anybody that started this year with Medicare Part B, this is your monthly premium, $170.10. This column doesn't change in terms of its number because this is the base premium. This column, though, handles Part B and that adjustment amount. If you're earning or if your income is too high, well, in this case, you don't have to deal with it, so the number is 0. Then you have Medicare Part D, and I put in an average premium of about $40 a month. And then this is the income adjustment or the penalty, whatever you want to call it, if your income is too high. Well, in this case, it's going to be 0. Then the very last column just simply sums up these four numbers, and it adds up to $210.10. Let's jump down to this area. Again, focusing on single. Let's say your modified AGI is between 114 and 142. Now you're going to have to deal with the surcharge. Your base premium for Part B doesn't change. Coincidentally, the surcharge is another $170.10 per month you have to pay. Your base for Medicare D is $40, and then the surcharge for Part D is going to be an additional $32.10 per month. So now you add up those four numbers, you have $412.30, just about double what you had under the very first level with no surcharge. I'm going to leave it at that. I think for tax planning purposes, when you're making decisions towards the end of the year, you want to be sensitive to whether or not you're in these ranges, for example, because if you go into these ranges, then you're going to pay much more on your premiums. So it's just something to be cognizant of. Let's talk about some other medical expense deductions. Again, the problem with all of these is that your medical expenses have to exceed 7.5% of your AGI, and then all of that gets applied to the limitations that I was talking about for other itemized deductions, and all that has to add up more than the standard deduction. But it's still good to know that this applies. So for long-term care insurance, this has to do with the premiums. So the way this works is you take the taxpayer's age at the end of the tax year, and this is the limit of your premium, how much of your premium you can write off. So you can see if you're age 40 or less, you can only write off $450 of that. As you work your way down, it goes up by basically 10-year increments or ages. And if you go down to this row, more than age 60, but not more than 70, then you can write off $4,520. So you can see the amount you're allowed to write off increases as you get older. Over-the-counter medical expenses, this has been, I'll say, enhanced or expanded a little bit more. They can be used now for health savings accounts or HSAs, which I'll cover shortly, flexible spending accounts, and then we don't see these too often anymore, but what are called Archer medical savings accounts. So it used to be this was much more limited, but now at least over-the-counter expenses can qualify for usage of these various savings accounts. So now we're going to dive into retirement plans. So if you are participating in a 401k, a 403b, or a 457b plan, and you have room to make contributions between now and year end, there are some opportunities to reduce your taxes. If you're using what I'll call the pre-tax option, then any additional amounts you put in will reduce your taxes accordingly. If your plan offers a Roth option, this could be a fantastic option, but the money you put into it will be after tax. So you won't have any immediate tax savings, but you'll have a lot of tax savings down the road. The limits this year, if you're under the age of 50, is $20,500, and a catch-up contribution is allowed for those that are age 50 and over, and that's another $6,500. IRA contributions. This always causes some questions in terms of what makes the most sense for people. I list it as being three types of IRAs: a deductible traditional IRA, a non-deductible traditional IRA, and a Roth IRA. One thing that is similar is that you can make these contributions up to the tax return deadline. So for this year's taxes, that would be April 18th, 2023. The limit is $6,000, and the catch-up contribution, again, age 50 and above, is an additional $1,000. Now, to do any kind of IRA contribution, you have to have the earned income to support the contribution. So these next few slides are confusing because of the different IRA rules, and I'll just kind of cover the main parts of this. So you can write off a traditional IRA contribution, and if you're covered by an employer-sponsored retirement plan, so let's say you participate in a 401k plan, there's limitations on when you can write off the contribution, and it's all based on income and your filing status. So let's look at married filing joint. And if your modified AGI is up to $109,000, you can write off your full contribution. And this is one of those contributions that are taken into consideration before AGI is calculated, so it's a very good benefit in that regard. If your income or your AGI is between 109 and 129, you can write off part of your contribution. It's basically prorated. And then if your income is above 129, you can't write off any of your traditional IRA contribution. Now, if that applies in your situation, you can still make the traditional IRA contribution. It will be non-deductible. So oftentimes I get the question, is that really worth it? And in most cases, the answer is going to be yes, because you still have the ability to get tax-deferred earnings along the way. And then oftentimes tax law changes will benefit those who have money in IRA accounts. We'll talk a little more about Roth IRA conversions. And the more money you have in an IRA, the more potential you have for some of these other benefits. So if you're not covered by an employer-sponsored retirement plan and you want to make a traditional IRA, then the entire amount is deductible. There's no limitations, no AGI limitations, but you can't be participating in a 401k plan, for example. For a Roth IRA, there are income limitations. So we'll look this time at single, just to, again, hopefully make it somewhat clear on how these rules work. So you take your modified AGI, and if it's up to $129,000, you can make a Roth contribution. If it's between 129 and 144, it's a partial contribution. If you're above 144 of modified AGI, no contribution. So there are ways to get money into a Roth IRA or into a Roth type of an account. If your employer offers a 401k plan, 403b, 457b that has a Roth option, there's actually no income limitations for that. That's a great way to get money into a Roth type of an account. And then Roth IRA conversions are another way to do that because there's no income limitations. So for those of you that are self-employed, an individual 401k plan can make a lot of sense. And the tricky part is you have to have it set up by year end. The contribution deadline is your tax return deadline plus the extension, so basically October 15th. It's attractive because it allows a higher contribution than a SEP IRA, which I'll cover, I think it's on the next slide. And basically, if you're self-employed, you have an individual 401k plan, you're making both parts of the contribution. And what I mean by that is the salary deferral that we're used to in a 401k plan through your employer. Well, you're the employer and you're the employee. So you have the same contribution option. And then because you're the employer, there's also a profit sharing contribution you can make as well, which is 20% of your net income basically. So it's pretty attractive that way. Now you can set these up with a Roth option as well, another great way to get a Roth type of an account without any income limitations. And the maximum this year is $61,000, and there's a catch up which brings it up to $66,500. So it's pretty attractive in that way. And actually, this number should be $67,500 as the catch up is $6,500. But you can get up pretty quickly to a high contribution number. And this makes sense to at least set it up because it will allow you the highest contribution amount available, with the exception of a pension plan. So your SEP IRA, one of the benefits of the SEP is that you can set these up at the last second. So you can set this up before or right when your tax return deadline is coming, plus the extension if you've extended it. The contribution deadline is the same. And what makes that individual 401k so beneficial is the SEP IRA only lets you do the 20% of net self-employment income contribution. It does not allow an employee contribution. The contribution limit for the SEP is $61,000. They don't allow a catch-up contribution, but realistically, to maximize these, your income's got to be a couple of $100,000 to get there in the first place. This takes kind of another level if you have self-employment income that is high enough and you're the only person working for your company. And a pension plan will allow you to get really high contribution limits in most cases that can be tax deductible and can be really beneficial. Now you have to work with an actuarial firm to set these up. It might be a little late to try to get one in for the rest of the year or for this year, but you might be able to do it if this is a possibility in your situation. And as soon as you hire somebody else for your small business or your solo in business, then that employee is going to become part of this calculation, and you probably want to revisit whether that makes sense or not. So let's talk about HSAs or health savings accounts. So you are able to contribute to an HSA when you have a high deductible health insurance plan. The big benefits of the HSA is that you write off the contribution, the earnings are tax deferred, and then if you use the money for medical expenses, it's tax free. So it's a triple tax benefit. It's the only vehicle that really allows that. So it's very attractive from that standpoint. Now, there are some rules and what is a high deductible plan. So this we'll talk about 2022's limits, and I have it broken up for single and a family plan. We'll cover the family plan in this example. So the maximum contribution limit this year is $7,300. There is a catch-up contribution of an additional $1,000 for age 55 and above. There is on the health insurance plan side, you have to have a minimum deductible of $2,800 and a maximum out-of-pocket exposure of $14,100. So your health insurance plan itself should say pretty clearly if it's a high deductible plan or not, but you want to make sure that it is, and then you're able to contribute to the HSA. If you take money out, what's called a non-qualified withdrawal, so for something other than medical expenses before the age of 65, you're going to pay taxes and a 20% penalty. So obviously you want to try to avoid that. If you wait till after 65 and do a non-qualified withdrawal, it's still taxable, but the 20% penalty goes away. Now what gets tricky for those that are age 65 and you're looking to get on the Medicare, as soon as you get on the Medicare and you have Medicare Part A, you can't make an HSA contribution any longer. It's just a rule, something they're talking about maybe removing. But right now, once you get to age 65, if you're still on an employer plan that doesn't require you to get Medicare, then, and it is a high deductible plan, then you can still make the HSA contribution. For those of you that have flexible spending accounts, don't forget about these. You are able to put in $3,050 per calendar year. This is where you take part of your earnings, your salary, and you put that money into a flexible spending account. And the benefit is that it's pre-tax. Then you want to take the money you put into the flexible spending account and you want to use it up. There's two ways to do that. Your employer either has it set up where you have to use those funds by March 15th of the following year, or they might have an option where there's a $500 carryover, but the problem there is you have to use it or lose it by the end of that calendar year. So it just depends on which option your employer has chosen, but the main thing you want to be careful about is that it is a use it or lose it type of situation, except for the carryover in this option. Social Security taxation. This is an important one to understand for those that have Social Security coming in, and we're talking about all these different phase-outs and modified AGI. Social Security taxation oftentimes is sort of left to the wayside. So the way this works is there's a calculation that's called provisional income, and it's where you take your AGI plus half of your Social Security income plus any tax-exempt municipal bond income. So whenever you calculate that number, then it applies to this following slide. If your provisional income, and we'll look at married filing joint, if it's under $32,000, the amount of Social Security subject to income tax is actually zero. If it's between $32,000 and $44,000, up to 50% of it's taxable, meaning Social Security. If it's over $44,000, up to 85% of your Social Security benefit is taxed. So main takeaways, if you're doing some year-end planning, you're receiving Social Security and you're sort of in maybe one of these thresholds, planning decision you make, you want to understand the impact for it. Another point to make is that with your Social Security benefits, up to 85% is taxable. So never in a situation is 100% of your Social Security income taxed. There's a different kind of rule called the kiddie tax. And what this means is where if you have a child and they have portfolio income, they have a taxable account, and what happens is that the IRS doesn't want you to like gift all this money to the child and it will have a lower tax rate. So the way it works is that once they get over a certain threshold of income, which I'll cover in a second, then the income is going to come back to the parents and be taxed. This applies for a child under the age of 19 or age 24 for a full-time student. And basically, if the child has earned income, the earned income will not apply. It's really portfolio income that is the main focus here. So the way this works, and for unearned income, If the child has less than $1,150, there's no taxes at all. The standard deduction for a child takes care of that. If the unearned income is between $1,150 and $2,300, the child does have an income tax rate, which would be lower. However, once the unearned income is above $2,300, then the higher the parent's tax rate or the child's tax rate will apply, and most likely that'll be the parent's tax rate. So just depending on your situation, if you have a child and you have a custodian account set up, you want to be careful about the type of investments you have because you might have some unexpected tax bill coming. Education planning, a couple of things I want to mention here. 529 plans are still a very popular way to fund education. These are tax-deferred accounts where if it's used for education purposes, primarily undergrad and graduate school, then all of those earnings will be tax-free. They've made a few enhancements over the years. One of those is that you can use a 529 plan to cover part of the cost of K through 12 education or a private school. So up to $10,000 a year can be used for that purpose. Something else to be careful of, depending on the state you're in, is that if you're in a state, they might require you to have that state's 529 plan. And if you put money into it, you have maybe an income tax deduction. Pennsylvania is actually a little bit different. There's only a few states that do this. They allow you to have an income tax deduction if you put money into a 529 plan using any state's 529 plans. So it's kind of an interesting rule that they have in Pennsylvania, and that is capped at $16,000 per person. So it's something easy to forget about if you're putting money into a 529 plan and your state allows that deduction. But you might be in a state where you have to use that state's plan to get the write-off. 529 plans can now be used for student loans, but there are some limitations on this. You have a lifetime limit of $10,000. So that's it, but at least it's better than zero, which is where it was before. And there is talk about increasing that number, but nothing has been passed at this point. 529s can now be used for apprenticeships. So a couple of years ago, that was a new rule put into place. And so when I'm saying they can be used for these different areas, it means the tax-free withdrawal component applies. You can still use funds for whatever you want, but there will be taxes and a 10% penalty on the earnings if it's for something that's not qualified. But at least apprenticeships now are allowed to be used, or a 529 plan is allowed to be used for that. There is still what's called a Coverdell Education Savings Account. They used to be called Education IRAs. There's a contribution limit of $2,000 a year per person, and these can be used in addition to undergrad and graduate school. It can also be used for elementary school or private schooling. So these have to be used up by age 30, and really a whole entire presentation on education planning and talk about the nuances of it. You just don't want to forget about some of these options that apply. It's kind of like the IRA. You can set it up until the tax return deadline for the prior year. And again, if these funds are used for education expenses, it is tax-free. A couple of other credits to talk about for education. There's what's called an American Opportunity Tax Credit. It's used for undergraduate school. 40% of the credit's refundable, meaning if your tax bill is zero, some part of this tax credit then could still be provide a refund to you. So the way this works is that it's a $2,500 credit per student per year. It applies for the first 4 years of undergraduate school. There are income limitations, which you can see here, married, filing, joint, and for single. So it's important to see whether this will apply or not. You want to count on the credit if your income is going to be too high. Then you have a lifetime learning credit, and this is a $2,000 credit that can be used for higher education, and there's no limit on the number of years. And then you have income limits that apply for this as well. There is still a student loan interest deduction of $2,500 annually with income phase-outs or income limitations. Then we'll talk a little bit about Medicare taxes. So we talked about Medicare B and D. This is a situation where you could pay additional tax if your income is too high. So the way this works is that if you have wages For somebody single, if your wages are more than $200,000, then you get hit with an additional 0.9% tax bill. Medicare taxes are 1.45%, but if your income is or your wages are too high, you have an extra 0.9% that you have to pay. So you might have a situation where maybe you can have a bonus deferred into the next year. So you might have some planning decisions you can make to maybe avoid this additional almost 1% additional tax bill. Yet I'm not going to spend too much time on this in the next couple of slides just because of time interest. But if you have questions on these areas, you can let us know. There's also a Medicare tax, an additional tax on unearned income. That's an additional 3.8%. And basically, it applies to unearned income, which will be portfolio income, capital gains, interest, dividends, if you have a rental property or any kind of a passive investment. Again, just realize that you have these different issues to consider, and that applies for single filers when their modified AGI reaches 200, married filing joint reaches 250. Now, the last set of information that I'll cover is pertaining to required minimum distributions. So there's been a lot of rule changes on this, so it's important to be very careful on this. First thing is that they've increased the age that you have to start taking a distribution to age 72. For the longest time, it was age 70 and a half, and then in 2019, everything changed. So the way this applies is that it will apply to your IRA accounts, and if you still have a 401k, 403b, or 457b plan, it will apply to this as well. And this is the way the IRS is basically saying, you've been deferring tax for so long, now you have to take the money out and pay taxes on it. So the way it works is that you take your prior year-end balance and you divide it by a distribution period, which is basically a life expectancy table. In the first year, it's about a 4% distribution, and then years afterwards, that increases by about 1%. So the tax planning is very important for this because your tax bill will increase from your required distribution on an annual basis, provided the account balance has gone up or maybe stayed stable, because the distribution percentage actually goes up a little bit each year. Now, for those that have inherited an IRA, this has changed a lot as well. This is different from the age 72 distribution that I just covered. So for a non-spouse and somebody passed away before 2020, the way the calculation worked is that it would take the prior year-end balance, and the IRS would give you a calculation that was also based on life expectancy. So you'd take the prior year-end balance and divide it again by that life expectancy number. It's a little different from the age 72 table that is used. Then what makes this really confusing is that each year thereafter, you take the new year-end balance at the end of the year, and then from that divisor, you subtract 1 from it every year and continue to do that in prior years. Thankfully for our clients, we keep track of all this for them, and because if you don't take the right amount out, it's a 50% penalty of the amount you didn't take. So it can get really, really costly. Now, if you have a situation where you've inherited an IRA, say from your mom and say from your dad, you have 2 separate calculations. You can't combine the calculations because the year of death will make a difference on that calculation. Now, for after January 1 of 2020, for a non-spouse, this is where the big changes have occurred. So as opposed to taking an annual distribution basically for the rest of your life, you now have to withdraw the IRA amount by December 31st of the 10th year after the original owner died. So it applies to traditional and applies to Roth IRAs that you might inherit. And that will apply again for non-spouse beneficiaries. So you have basically 10 years to take all the money out. You can do it all at once. You can spread it out over 10 years. This becomes a very important income tax planning calculation that you want to go through. Now, if you are a spouse that inherits the IRA, you can still take the required minimum distribution based on life expectancy. That 10-year rule does not apply, and there's a few other exceptions to that. For a minor child, and that rule will apply or will not apply, until that child reaches age 18, then the 10-year period kicks in. For somebody that's disabled or chronically ill, this will not apply. And then if you've inherited an IRA and you're within 10 years of the age of the deceased, then the 10-year rule does not apply. It's really confusing. You have to really sit down and look at each scenario and kind of map this out, which we do take care of for our clients. And the last thing I'm going to cover is what are called qualified charitable distributions. And I realize we're just about at 1 o'clock. This is a really important tax planning strategy you can still use this year because we have plenty of time to do that. If you are required to take a distribution from an IRA account, for example, you can actually gift that to charity, or you can gift up to $100,000 annually to charity. And if you do that, then that amount will not be taxed. It will count towards your required distribution. It's a very big benefit because that tax break comes right off the top. So if you're in a 25% tax bracket, just to throw out a percentage, and you gift $10,000 to a charity from what's called a qualified charitable distribution, that's $2,500 less your tax bill will be. So it's really important to understand and take advantage of this if you can. If you're itemizing your deductions, you cannot you can't double dip basically, and you can't use it as an itemized deduction as well. It first becomes available at age 70 and a half. So even though the rules changed to age 72, this particular rule stayed the same. Once you're 70 and a half, you can take advantage of that. So that's a very big planning opportunity that we're encouraging our clients to take advantage of if they have charitable intentions that they want to take advantage of. So with that, I'm going to stop here to take any questions that have risen. I know we went through a lot of information. And the tax law changes have been pretty quiet over the last couple of years, and there hasn't been too many big changes. These required distribution changes have been really the biggest ones that have come about. And again, the penalty is 50% of the amount you're required to take out that you didn't take out. So if it's you're required to take out, just say $20,000, and you took nothing out, well, your penalty is going to be $10,000, and you still have to take the money out and pay taxes on it. So this can get really costly really quickly. So if you have questions about your situation, feel free to reach out to us, especially when it pertains to an inherited IRA and the different rules around spouse versus non-spouse and understanding your options. So we have a couple of questions that have come in. One pertains to if you're selling your house, does that affect your Medicare premiums for 1 year? So let's say you do sell your house, and let's say the capital gain is higher than what the exclusion is set for. Because just because you have a capital gain on your house, if you sell it, that doesn't mean that that amount's going to be taxed. But let's say it is. And in that case, it will affect that Medicare premium based on that 1 year. So one thing I didn't mention when we talked about that is, let's say the Medicare, I call it a surtax or surcharge, applies for 2022, or your income was high enough that it's going to apply. It doesn't impact you until 2 tax years later. So that premium will jump up in the year 2024. So there's always a 2-year lag basically from the year where your income is too high to the year it impacts the Medicare premium. And that's just simply the case because of processing the tax returns. The IRS can't process it immediately, so that it applies for your next year. It takes some time to get through all of that. And that's another important thing too. If you're in a situation where you're going to maybe consistently, or it could be consistently in those ranges of income where the Medicare surtax will apply, then you want to take a look at, well, maybe it makes sense to bite the bullet and just pay the surtax or generate enough income in 1 year, pay the surtax in 1 year, 2 years later, and then all the other years maybe you don't have to pay it. So there's a lot of planning that gets really involved in this when you're maybe looking to, maybe you're going to incur a capital gain, whether it's on a house or an investment, whatever the situation is. So another question pertains to whether we provide estimated tax calculations, and that is something we can do. And we have software that's able to calculate that for our clients. So if we have enough information, yes, we can get a good idea of whether or not underpayment penalty applies and whether or not you need to make estimated tax payments. So it is something that we have that capability to do. And depending on how your relationship is with your accountant, some accountants will put that together. But usually for our clients' accountants, it's usually dealing with the tax return prep, and they might give you estimated payments at that time, but your situation changes all year long. And that's where, because we work with our clients all year long, we understand what those tax changes are, and we can help them in real time with that. Excuse me. Okay, so I have a couple of more questions I want to go through. So another question is, if you have an S corporation and you're the sole employee, can you have a SEP IRA plus a 401k plus a Roth? So basically having a number of different kinds of retirement accounts. So there are caps as far as how much you can put in to the retirement plans. So in this case, if you had, let's say you had a 401k plan, that's probably going to give you the best option to put the most in versus a SEP IRA. And I gave those calculations before, where the SEP IRA doesn't factor in yourself as an employee. It only factors in the employer contribution. So you can have those set up. You'd really be making contributions to one of those. The 401k would probably be the best option. And then within the 401k plan, you can have that Roth option. If you set up the account, you can make that selection to have a Roth 401k contribution, which is really beneficial because there's no income limits, and it's a great way to get money into a Roth type of an account. And there was one question in regard to a clarification question on the estimated tax payments. And the benefit of our software we use, we also can help with the state calculation, no matter which state you're in. This does factor in all the states that have an income tax calculation. A couple of clarifications on, or just with the qualified charitable distribution. So you can do that qualified charitable distribution as early in the year as you want. We are trying to work with our clients to get that information and try to complete it in the month of October, because what happens is that the custodian will make out the check to the charity. They can send it directly to the charity, but there's processing issues just because the year end gets really busy. We're finding it makes it a lot easier to get the distributions done in October. November still works, and even December can work, but you're just running up against the deadline, and it's important to just try to get them done as soon as practical. You don't have to do it at the very beginning of the year because you still have an account that is tax deferred. So if you can get maybe another 9 to 10 months of earnings before you do the distribution, that could be really helpful. Of course, in a year like this, where the markets have been down all year long, that has the opposite effect. You might have wanted to take the distribution earlier in the year, but of course you have no idea how the markets are going to be in any given year. But that's been one area too. When you do that distribution from a tax reporting standpoint, you want to make sure that your CPA is preparing your taxes knows exactly what you've done, because the reporting on the forms, they're basically, it's almost like an honor system. So you're required to make sure your tax return is correct, And if you've done qualified charitable distributions of a couple of $1,000s, you want to give that information to your accountant, and then they'll make sure it's reported accurately on the tax return. But your 1099 will not say that it's a qualified charitable distribution because they have no way to verify that you've handled that situation correctly. So just a couple of important tax filing aspects you want to keep in consideration. There's also some news. I got a question in regard to recent announcements about standard deduction going up a lot next year. And that is true. All these different phase outs and standard deduction amounts, they get inflated every year. And with inflation being so high this year, you're seeing bigger jumps in the year 2023 because of that. There's not too much that impacts for year-end planning for this year, but it is important to note that those numbers are going to change quite a bit next year compared to how much they've changed in prior years. And I'll wait a couple more minutes for some additional questions. Another question that came in about the qualified charitable distribution has to do with can it be done monthly if you donate, let's say, to a charity on a monthly basis? Yes, you can handle it that way. There will be more logistics involved coordinating that with your custodian, but you can do it monthly, or you can just simply do a lump sum. That might be easier for all intents and purposes, but I realize a lot of our clients will give to a charity on a monthly basis, or maybe every 3 months or something like that. You can continue to do that and take advantage of that, but it might be a little more difficult to keep track of all of that documentation. And so with these different moving parts, we're talking about Social Security, we're talking about the Medicare surcharges. There's all these different rules that basically penalize you with higher income, and none of them are the same. So the big thing that we do for our clients is that we can run the projections and get an idea of whatever tax planning move is being considered to understand the impact on maybe it's Social Security, or maybe it's those Medicare premium surcharges I was referencing before. And so those can be really important planning issues to be able to run the numbers, see that if you maybe sell an investment or you're trying to do some tax loss selling, that could be really important, not just because you're going to reduce your capital gains, but maybe you're allowing Social Security to maybe not be taxed as much. Maybe it allows you to avoid the Medicare surcharge. So that can be really, some of the impact on the planning can be really important to do. And just the kind of the unintended consequences of a tax decision and can be really important. And then another question about the qualified charitable distribution. If you have a non-spouse IRA, so you can do that qualified charitable distribution at age 70 and a half. So it's a weird, I guess, rule that didn't change when they lifted the age 72 or the required minimum distribution from 70 and a half to 72. They kept the qualified distribution, charitable distribution at age 75. So you can actually start doing that before you reach age 72. I have no idea why they didn't raise it up with it, but they didn't, and maybe that'll happen eventually. But most people are thinking now that age 72 is that beginning age, and that is true for the required distribution for a non-inherited account. But the qualified charitable distribution rules did not change. And that rule applies for whether it's an inherited IRA or non-inherited IRA, I guess, for lack of a better term, meaning that if you have an inherited IRA that you received when you were, say, age 50, you can't do the qualified charitable distribution until you reach age 70 and a half, even for the beneficiary IRA. Okay, a lot of good questions. Let's see if we have any more coming through. I'll wait another minute or two. Excuse me. Okay, it looks like that's the extent of the questions, but if you have questions after the fact, if you want to reach out to us, feel free to do so. We can talk about your situation a little more specifically and give you a little more specific guidance. And again, we'll be sending out the replay for this webcast so you can spend maybe some more time on an area that means more to you than perhaps another section of the webcast that I covered. So with that, I'm going to turn it back over to Dan.
Okay, great. Thanks, Jim. You covered a lot of great information today, and I want to thank everybody for joining us for our webcast. If you would like to schedule a free conference call consultation with a member of our advisory team, please call our office at 412-635-9210 to set up an appointment. Thank you again for attending, and this concludes today's event.